How high can Singapore REIT yield? 12%! Seriously, for every $100 you invested in this S-REIT, you could potentially make $12 on a yearly basis. But wait a minute, isn't that too good to be true? Hi, I'm Frankie. Welcome back to my fuck show. This Singapore REIT is EC World REIT, a REIT that focuses on e-commerce, supply chain management and logistic purposes properties in China. Since November last year, EC World REIT has lost a third of its value as the REIT price dropped from 82.5 cents to just 53 cents, making the dividend yield looks rather attractive at 12% at the current price level. So is this a bargain? Let's find out. Since EC World REIT is technically a Chinese REIT listed in the SGX, we need to talk about the background of the property sector in China to help us gauge the situation faced by the REIT. Property and related industries are one of the largest GDP contributors to China, estimated to make up as much as 25% of the country's GDP. The sector took off after market reforms in 1998. Since then, there was a breathtaking construction boom on the back of demand from a growing middle class that saw property as a status symbol and a key asset to own in order to start family planning. Chinese banks saw a great opportunity to make money and started filling the market with easy access to loans to both developers and home buyers. If you watch my previous video talking about Chinese developer Evergrande's ballooning debt problem, you know that in China, one of the most common ways property developers make money is to use the funding from previous property sales to make new land leases from the government. With new land in hand, they then launched more properties and made new sales to generate more profit. The developers were happily doing that over and over again, but neglected the construction progress in the past sales.
I missed the part where that's my problem.
In the end, developers became addicted and rely heavily on pre-sales, with buyers paying mortgages on units that take forever to build. That worried the government because over many years, the developers were fading on debts and mortgages have made up almost 20% of all outstanding loans in China's entire banking system today. As a result, China launched a crackdown last year, with the central bank capping the proportion of outstanding property loans to total lending by banks to try to limit the threat to the financial system as a whole. This squeezed sources of financing not just for developers but dragged on other industry players as well, such as EC World REIT. As at the end of 2021, EC World REIT has an outstanding loan of 612.4 million Sing dollars. This number may seem like a big number to some people, but under normal circumstances, it shouldn't be a problem as long as the REIT is able to service the loan, or at least refinance the loan to extend the tenure of the repayment. For some reasons, most of the banking facilities that EC World REIT has will expire in 2022. I wonder why the REIT managers did not spread out the tenure of its facilities in the past for better risk management purposes. Anyways, it's too late to do anything now when the Chinese government decided to crack down on property sector by limiting bank borrowings. Nobody saw this issue coming for the REIT because the property crackdown imposed by the government was limited to the residential properties, which has nothing to do with EC World REIT because they were managing property assets in the e-commerce and logistics sector, not residential properties. For the banks, it doesn't matter. To them, if the Chinese government is cracking down on properties, then they might as well be more cautious in giving out any property-related loans just to play safe. Suddenly, EC World REIT caught themselves in a huge problem. If banks are reluctant to refinance EC World REIT's facilities, the REIT may default on its facilities and the implication can be unfavorable to unit holders. This has become the primary reason for the weak share price performance for the REIT in 2022. Investors are clearly nervous, but lucky for them, the REIT managers managed to buy themselves some time by extending the REIT offshore loan expiry to April 2023 on the condition that EC World REIT must repay at least 25% of the aggregate principal amount of the outstanding offshore facilities by the end of 2022, failing which EC World REIT shall face an event of default. If that happens, it will trigger cross defaults across EC World REIT's other existing facilities, such as the onshore facilities and its revolving loan facilities. Things will get really ugly by then. Therefore, there's no time to waste. The REIT managers have already signed and announced the entry into a non-binding MOU with the sponsor of the REIT to explore the potential divestment of two of EC World REIT's assets that collectively worth around 400 million Sing dollar. Even if the REIT managers sold off those two key assets to pay off their financial obligations, it would mean EC World REIT would not be able to generate future rental income from those assets anymore. Lesser rental income equals lesser potential profit for the REIT holders going forward. To make things worse, the REIT has been served with a compulsory expropriation on one of its other assets under management, known as Fuzhou Industrial, a port property which comprises berth and office buildings that is located in the north of Hangzhou. If there's any consolation to it, EC World REIT will be compensated with 108.5 million renminbi for the expropriation exercise, which translates to 92.8% of latest valuation and 26.8% higher than the price it purchased in the past. Being a REIT that focuses on e-commerce and logistic play, we have to talk about the market condition in that sector. We all know that the COVID-19 pandemic has caused major disruption in the global supply chain with shutdowns of industry around the world, causing lower consumer demand and reduced industrial activities. When COVID cases began to spike in China in late February, the country continued to adhere to its zero COVID policy to curb the spread of the virus. Under this policy, it is said that at least 373 million people in cities that represent roughly 40% of China's GDP have been affected by the most recent wave of lockdowns across China. Suspension of business operation and production, as well as widespread lockdowns in China, are expected to disrupt the logistics sector significantly. Such negative sentiment has become a recipe for share price disaster for the REIT in recent months. Depending on who you talk to on the matter, some investors would think the unfavorable situation that EC World REIT faces today is a unique opportunity to accumulate more on the REIT. Once the REIT sold off the two assets we discussed earlier, the REIT could unlock the value of the REIT and partially pay down its financial obligation. If there's leftover, there's even a chance to receive a one-off special dividend too. For me, it is important to weigh the costs and benefits between a super high yielding REIT and its ability to service most of its loan in the next 12 months. Honestly speaking, there are thousands of stocks to choose from around the world. So why be so obsessed with this one? But if you chose to take a bet on it, and if they manage to weather through these difficult times, then perhaps you have found yourself a wonderful asset to invest in. Life is so difficult sometimes. That's all we have for today. #fuck.